income taxes. Yay! We've got some definitions to start with, and these definitions that we begin with are actually they're not as important for the concept multiple choicey type questions as they are in you have to know what you're being told in the problem to understand what you have to do to it to get to the answer that's requested. So these definitions are ones that you're going to have to know pretty much in practice, not just memorize what they are. Gross income, that's your total income, so that is basically all the money you take in. No matter where it's from, all of your income gets added up together, and that makes your gross income. Now, sometimes you'll be talking about in a problem that you put money into an IRA or other kind of retirement account. Most retirement accounts are what we call tax deferred. Tax deferred means that you don't pay taxes on that money when you earn it. You get to put it away into a savings type account, and you get taxed on it when you withdraw it. So you still get taxed on it, but you get taxed later. That's the tax deferred. So all your income is your gross income. If you have any of these adjustments, like for an IRA, you get to subtract those off. Once you subtract those tax deferred contributions from your gross income, that gives you what we call your adjusted gross income. Once you have your adjusted gross income, you get to take exemptions from that. Exemptions are $4,050 per person that you support financially. So you always count yourself as one exemption, and then if you're married, if you have kids, each person in your household is another $50 that you get to take off your income. Deductions, you've got one of two kinds. You have the standard deduction, which just goes for your filing status, so you don't have to do any work. Or you can do itemized deductions, which means you have to go through a whole lot of receipts and things like that to see how much you actually spent. And once you do, you get to take those off your income. Now, this is an either or. You don't get to do both. So if you go through in real life, if you think you're going to itemize deductions, you might go through the procedure and figure out what your itemized deduction would add up to. But in reality, once you do your itemized deductions, if you look back at the standard deduction and the standard deduction is less, you'll do the itemized. If the standard deduction is more, you're going to actually take the standard deduction instead of the itemized one, even though you went through all the trouble. So if I have my adjusted gross income and I subtract off my exemptions and my deductions, that gives me my taxable income. Taxable income is the income you actually pay taxes on. That's the system that we use, which means that people with higher taxable incomes pay a higher tax rate. That doesn't mean people who make more money pay more taxes. If they have more deductions, their taxable income could actually come down quite dramatically. Tax credits. Tax credits come off of your tax bill, so after you figure out how much tax you owe, you get to subtract off any tax credits you may have. Our first problem is one where all we're doing is really working with the definitions. We want to find gross income, adjusted gross income, and taxable income just by definition alone and the information that we're told in the problem. So if we start, the first question is to find the gross income. That's all of her income. So she earned $34,200 in her job. Plus she got interest in her savings account. So that counts. Any money you receive counts as your gross income. So if you add up all the money she received in 2017, that would be $34,950. Adjusted gross income, AGI for short, adjusted gross income, means I start with her gross income and subtract off any retirement contributions she made. Now, if she didn't make any, I'd be done. My adjusted gross income would just be the same as my gross. But since she did make a $1,200 contribution to an IRA, I subtract that off, and her adjusted gross income is now $33,750. That's not how much she pays taxes on, though. I need one more step to find her taxable income. Now here's where you have to use the tax table, which is listed under your homework. It's listed under your notes, right under this sheet. I'll be giving you a copy of that on the test. That'll be the cheat sheet I provide you. So all the stuff that's on that tax table sheet, you don't have to put on your note card. You'll have that sheet exactly the way it looks. But we start with her adjusted gross income, $33,750. And then we look at her filing status. It says she's single, and it doesn't mention that she has any kids or anything. So, single, if you look under single, the amount of her standard deduction is $6,350. And then because she is the only person she supports, I take off $4,050 exemption. Subtract those, and the amount of money that she's actually going to pay taxes on is not her total income, but she's only going to pay taxes on $23,350 worth of her income. Now we stopped there because nobody asked us on this problem how much taxes she paid. This one, we're asked. So now we're going to have to use our tax table. Now the first part of the problem, don't just go straight to the money. You have to look at what type of money that is. If it's taxable income, I'm going to use the whole $87,500. It means everything we did in the first example has already been done to this income. So I got Sarah and Marco are married filing jointly. I go to my tax table and I look at that filing status. $87,500 falls in the 25% bracket. That does not mean that Sarah and Marco pay taxes that are 25% of their taxable income. It's a little more complicated than that. If you look at the table and you look at the 10% bracket, the 10% bracket ends at $18,650. Look at the table, not at the screen. What that means is everybody who's married filing jointly only pays 10% tax on the first $18,650 they earn. Now, the 15% bracket, they're going to pay 15% on all income up to $75,900. But $75,900 includes money that I already paid taxes on over here. I already paid taxes on $18,650. So it's 15% of $75,900 minus however much I've already paid taxes on. Now when I move up to the 25% bracket, the 25% bracket goes all the way up to $153,100. Sarah and Marco didn't make $153,000. They only made $87,500. So they only pay 25% taxes on the amount of money they made, minus, Now at this point, I've paid taxes on a total of $75,900. So I'm only paying taxes on the part of $87,500 that I haven't already paid taxes on before. Now, just a helpful hint. I don't know why it's true, it just seems to be true. You can do this in pieces and parts and then add them all up, but the people who do that tend to get the problems wrong. I don't know why that is. If you do each piece right, it should work out. But it seems to be, just from an observation point, that you should learn how to type this entire big math sentence into your calculator exactly the way it looks, and make sure you close all your parentheses and everything looks exactly like it does here. If I were you, I'd pause this, type that in, and make sure that the answer you get is $13,352.50. Now, in the real world, we just round these off to the nearest whole number. Well, I'm interested in whether you can do the math correctly, so we're not going to do any rounding. Leave your answer alone. Pat's had a household with a dependent child, and here's his income. But what kind of income is it? That's going to change how we start the problem. Sarah and Marco, we were given their taxable income. Adjusted gross income is not what I pay taxes on. I take my adjusted gross income and I'm going to subtract off the standard deduction for my filing status. Head of household, the standard deduction is $93.50. Now, exemptions are per person. I got Pat and I got a kid. So that's $4,050 for each one of them. And what I'm left with is $39,550. That is my taxable income. That's the amount I pay taxes on. That's the amount that I look for in my chart under the filing status of head of household. Now, it's in your best interest to pause this and see if you can write out that math sentence without my help. Head of household, we pay 10% of the first $13,350. Pat made more than $13,350, so we go on into the 15% bracket. Now, he doesn't top out the 15% bracket. He only goes up to $39,550 minus the $13,350 we already paid taxes on. That should give us an answer. $5,265 is the amount of tax he owes. Now, if I look, the very last part says he's entitled to a $1,000 tax credit. A tax credit comes directly off your tax bill, not your income. So if I subtract $1,000 off of there, the amount of tax Pat actually has to pay is $4,265. We have married, filing jointly, $90,000 each in adjusted gross income. So combined, that's $180,000. $180,000 adjusted gross means I have to subtract off $12,700 for the married filing jointly filing status. And again, there's two of them, so I subtract off personal exemption twice. That means Jessica and Frank are going to pay taxes on $159,200. And that's going to take you a minute to figure out. Again, your best course of study right now is to pause this and then see if you match up with what I did. Jessica and Frank pay 10% on the first $18,650 that they make. They pay 15% on all their income up to $75,900 minus the $18,650 they've already paid taxes on. They made more than $75,900, so we go to the 25% bracket. The 25% bracket goes up to $153,100 minus the $75,900 they've already paid taxes on. They made more than $153,100, so we go all the way up to the 28% bracket, not to the top of it, just up to the amount of money that they actually made, minus the $153,100 they've already paid taxes on. That gives them a grand total of $31,460.50 that they owe in taxes. Now the next question asks if they pay a marriage penalty. Generally speaking, we think of married people pay less in tax than they would if they were single. Well, that's not always true. Sometimes they actually end up paying more being married people than they would have if they were single. That's called a marriage penalty. If they pay less, it's called a marriage benefit. And sometimes they pay exactly the same amount either way. So, what we have here is before, let's remind ourselves, on the screen before, as a married couple, they paid $31,460.50 in taxes. That was as a married couple. To answer the question about a marriage penalty, we have to figure out Jessica's income and Frank's income separately as single people and see how much taxes they would have paid as single people and see which tax bill ends up to be more. So, each one made $90,000 adjusted gross income. As a single person, they'd subtract off $6,350 as a standard deduction. And as a single person, they would only subtract the $4,050 off once. So each would have a taxable income of $79,600. If I figure out how much tax, you can call this Jessica or you can call it Frank, but each one of them would pay as a single person, it'd be 10% of the first $93.25 plus 15% of $37,950 minus the $93.25 they already paid taxes on, plus 25%. We don't go to the top of the 25% bracket, so we stop at the $79,600 minus the $37,950 we already paid taxes on here. So Jessica or Frank, as an individual, would pay $15,638.75. That's for one of them. Since they make the same income, if I double it, that would tell me how much the two of them would have paid in taxes as two single people. Now, I believe in the homework you have two different actual incomes, so you would have to do this process twice. One for one income as a single person, Then you do it again with the other income as a single person, and then you would add the two tax bills together. So as single people, this is how much they would pay in taxes. If you compare it to how much they paid as a married person, where do they pay more? They pay more as a married couple. So yes, there is a marriage penalty here. If they had paid less as a married couple, that would have been a marriage benefit. FICA, I give you probably more information than you wanted to know about FICA. But it comes out of your checks, so I thought you might be interested. FICA is taken out of every check you earn. If you make money, you have to pay FICA. So you don't get to deduct anything off. FICA comes out of every penny you earn. You don't have to remember this part, I gave it to you, but this is just so you know how it's broken down. Generally speaking, 6.2% of every check you earn goes into Social Security, and 1.45% goes into Medicare, and that's supposed to pay for you using those services later in life, if they still exist, by the time you get there. This is the part that you want to remember. If it's your check, you pay 7.65% of your check, every dime you make, in FICA taxes. Your employer, though, matches that, which means you pay 7.65% of how much you make, and your employer pays 7.65% of how much you make. That's a total of 15.3% of your check. No, not of your check. Of how much you make, of your salary, goes into Social Security for you. Now, if you're self-employed, you're the employer and the employee. So instead of taking 7.65% of your check, you have to take the whole 15.3% out, because you'll be paying both parts. This problem is going to be a portfolio problem. So you want to pay careful attention, not just to be able to do the homework, but also to be able to do your portfolio assignment. We've got Jude earned $26,000. We want to find her FICA taxes, her total tax bill, overall tax rate. Oh my word. All right, one thing at a time. Let's start with FICA. FICA, you get no deductions, you get no exemptions. It's 7.65% of however much money you earn. Period. So in FICA taxes, Jude pays $1,989. So we did FICA tax. Now we want total tax bill including marginal taxes. Marginal taxes is the federal income tax. That's what we were just figuring. So we got to find our federal income tax before we can add the two together. $26,000 is her gross income. Did she give any money to an IRA? Doesn't appear so. So $26,000 is also her adjusted gross income. She is single. Single and takes a standard deduction. So as a single person, it's $63.50 for her filing status. And it doesn't say anything about her having any other dependents, so $40.50 exemption. And we get a taxable income of $15,600. Take that to the tax table. 10% of the first $93.25 plus 15% of $15,600 minus the $93.25 we've already paid taxes on means her federal income tax bill will be $1,873.75. Let's change colors here. So her total tax bill is the $19.89 that she paid for FICA plus the $1873.75 that she paid in federal income tax. That makes her total tax bill $3862.75. That's her total tax bill. And we got one more question. I'll change colors again so we can keep track of it. We want to find our overall tax rate. Overall tax rate she paid $3862.75 in taxes total. We divide that by her total income and change that to a percent. So her total tax bill is 14.9%. Now you're going to do this exact procedure step by step in a portfolio assignment. Last thing we are going to look at are capital gains. Capital gains are essentially profits. Most people receive capital gains when they sell a house or something. That may or may not have different restrictions on it depending on how you got your mortgage. Most of the capital gains laws are for people who live off of investment income. So they get dividends off of stocks and bonds and things like that. They're taxed totally differently. First of all, there's no FICA tax attached to these because it's not earned income. Secondly, while we will look at the filing status of a person, we'll use the federal income tax table, we're not going to use it the same way. We're going to look at a filing status, and all the money that falls in the 10 or 15% brackets, that's free money, no tax. Anything that is in the higher tax brackets only gets taxed at a 15% rate. So let's see what this means in practice. Serena lived off an inheritance. Her gross income was $90,000. It's all in dividends and capital gains. But we want to find how much tax she owes. Well, it's not part of the question, but just to reiterate, she pays 0% in FICA because she didn't earn any of that. So when we're trying to find her total tax bill, we're only talking about the federal income tax. $90,000 is her gross income. It says she has no adjustments. That means she didn't give any money to an IRA. Therefore, it's also her adjusted gross income. Okay. But we have to get down to taxable income. She had $12,000 in itemized deductions. The standard deduction for her filing status is $63.50. So $12,000 is more. You take the higher of the two. And then she has one exemption because it doesn't mention that she's supporting anybody but herself. And that means her taxable income is $73,950. Now what we do with that $73,950 is different. We do take it to the tax table. Look under the single filing status. Look at the top of the 15%. The top of the 15% bracket is $37,950. We subtract that off because that part is not taxed. Whatever part falls in the 10% and 15% brackets, not taxed at all. The only part that gets taxed is the $36,000 that's left. Now again, we don't need the table to figure out how much it's taxed because it's capital gains. There is a flat 15% tax on that $36,000. So she will owe $5,400 in taxes. Now if we want to find her overall tax rate, that's the $5,400 that she paid in taxes divided by her total income. And that works out to be an even 6%.